Are we going to see demand destruction as oil moves up, or is it inelastic?
Look, Tom, I mean, high prices always fix high prices. So we are certainly going to see some demand destruction. One of the challenges, and you may remember this from back in '08 when we were talking about these issues, is that as prices go up, governments tend to use fuel subsidies as a tool to keep people happy. So we are seeing a curtailment of fuel taxes across much of Europe. We've also seen some U.S. states doing the same thing, Mexico, many emerging markets. So as prices go up, governments try to reduce that elasticity, and they don't let prices work very much. And therefore, you end up getting bigger movements on the wholesale market, which is kind of what we've seen so far. So that's a big issue. And the other big issue, obviously, is that we have, as I like to say, the mother Russia of all supply shocks. It's just a very, very big supply shock.
Francisco, I got to go here because Brian Moynihan in Davos was exceptionally positive on the resiliency of the American consumer. Do you care about the price elasticity and demand destruction as gasoline goes to $7 a gallon?
I do care, but I will say that if you look across the world, and this is probably one of our most popular pieces of work, which is the energy share of GDP across the world is actually quite high. We're almost back to the Iran revolution levels for the entire planet in terms of the amount of income that we spend in our energy. I'm talking about quantities of oil, gas, and coal multiplied by the price and divided by a nominal GDP. But in the U.S., you have a twist, and the twist is that you haven't had the global gas and power crisis that we've seen in Europe, that we've seen in Asia. So the U.S. is not enduring record high natural gas or power prices. And I know Henry Hubb's up, but at the end of the day, the U.S. is not facing the same kind of energy prices in aggregate that the rest of the world's suffering from. So I think the U.S. is a lot less exposed. Plus, also remember, the dollar is very, very strong. So that means America has been insulated also more so than other countries that are facing this incredibly strong dollar and strong commodity prices. And perhaps the third fact here is that the U.S. is energy independent on its path to become energy dominant, which in my mind also shields the U.S. from the vagaries of global energy prices. So I think, yes, we're going to see recessions, but the question is where and when. And the U.S. is probably, in my mind, at the bottom of the list in terms of the countries that will be impacted by this skyrocketing energy prices.
So, Francisco, there's a lot to unpack there. I want to just first get your sense of how close we are to a full-blown, as you call it, 1980s-style oil crisis.
Right. We're not that far. I mean, I think we've seen the global gas and power crisis already in the past 12 months. It started with thermal coal in China. Remember, the most expensive energy commodity ain't oil. It's really been thermal coal and natural gas. We are at $400 a ton of thermal coal. That's twice the level of what we saw back in the financial crisis in '08 when oil went to $147 a barrel. Again, $400 a ton. That's about $100 per barrel of oil equivalent. So oil at 110, 115 ain't expensive when coal's almost the same price level. And then natural gas has also been at record levels in Europe. We've seen nearly $500 a barrel of natural gas prices, about $80 an MMBTU at the highest back in March. So that's what the real issue is. Oil is yet not in crisis. It could go into a crisis though, and I think that's the real problem here with the way that sanctions may be implemented. How much Russian supply do we end up losing, and how can that impact the supply-demand balances here? That's what I'm worried about.
Francisco, I'd love some real-time analysis from you on the headlines we're getting from OPEC+. Delegates indicating that they could be discussing an additional 600,000 barrels a day against the scheduled 430,000. Also, some indication they might decide today on July and August hikes. Francisco, I'll tell you what the market's doing off the back of this. It's raising losses. Crude's down about 0.6%. WTI back to 114.50. What's your read on those kind of headlines?
Well, my read is that OPEC Plus collectively does not want to be blamed for oil prices skyrocketing here on the back of the European sanctions on Russia. So they're trying to increase production and mitigate the upward price pressures. But remember, one of the biggest challenges that OPEC has in this market is that it doesn't have the spare refining capacity. Russia is not only the world's second largest crude oil exporter, It's also the second largest refined petroleum product exporter, and 40% of the diesel that goes into the ICE contract, into the gas oil contract, most important diesel contract in the world, ICE gas oil, is actually Russian. So you're taking a lot of supply out of a very tight market, and unfortunately, when you don't have the refining capacity available in Europe, sanctioned both crude and petroleum products, there's not that much that OPEC can do. They can try to keep a lid on crude oil, but that's not necessarily going to help the price of diesel, the price of gasoline, which is ultimately what people buy at the pump.
Well, Francisco, just a final word from you then on that topic. OPEC can't do anything, seemingly to influence the price of things at the gas, according to what you just said, because of refining capacity. Where does it leave the administration here in the United States as the president, according to our reporting, gears up for a meeting with the Crown Prince? What can the president do here in America?
Well, look, I think we continue to do what we've seen, release a little bit of SPR. The SPR has some barrels of petroleum product available, which are being released into the market. I think the challenge is, honestly, is that we are tight on every front. Commercial inventories are very low, as are government inventories, because we're drawing them quickly. So I think perhaps we should be started thinking about demand rationing measures. Maybe stop subsidizing fuels, but more importantly, maybe think about limiting speed on highways and doing things that actually.
You think, Francisco, that's where this could go in this country? Demand rationing?
Well, maybe not in the U.S. Maybe you have enough capacity in the U.S., but certainly other parts of the world, I think, are going to have to end up seeing some demand rationing. I think so. I think we're going into demand rationing mode on the back of these measures against Russia.